This is a short video and it's hopefully not last more than 5 minutes, and it is not meant to be educational, and it is not part of the series on international accounting standard that is currently being published in my YouTube channel. I titled it In Defense of the International Accounting Standard number 23, Borrowing Cost. I'm trying to defend the accounting treatment prescribed by this standard. Because there is some argument going on about why we capitalize the borrowing cost sometimes we don't. Let us give a short summary of the content of the standard. The standard is about the borrowing costs that are directly attributable to the acquisition and construction of the asset. If a company took a loan to finance the construction of an asset during the construction period, we pay interest on this loan. These interests are directly attributable to the asset, because without the asset we would have not taken the loan. I don't want to talk much about the qualifying assets because this video is not meant to explain the standard in depth. I have to make a small point, but before that I have to see the content of the standard itself. The qualifying assets normally takes time. So if you are buying a ready-made asset, that will not qualify. It should take a period of 1 year or so. That is building an asset from scratch. Taking a loan, definitely the company will suffer costs in the form of interest, borrowing cost or finance cost on the loan. The finance costs during the construction period should be capitalized. Let us see. Therefore, and as per this standard, all borrowing costs relating to qualifying assets under construction should be capitalized. The meaning of capitalized, we add it to the value of the asset. That is, we increase the value of the asset during the construction period with the amount of interest payable on the loan. The capitalization definitely will continue during the construction period until the completion. After the completion, it will be taken to the profit or loss account, and we stop capitalizing it. That is, we stop adding it to the value of the asset. Now, what's the logic that underpins this capitalization during construction and not after the construction? In fact, there are 2 points that support this accounting treatment. The first one, it is in line with the matching concept. The treatment is in line with the matching concept, which we know in the accounting standard, because before the completion of the construction, there is no revenue or cash flow or economic benefit that inflow to the company from the use of the assets. So there is no revenue, but there is interest payment. So if we take this interest to the income statement as expense, then there will not be equivalent or a matching amount of revenue relating to that expense. So we stop sending it to the income statement, or we don't take it to the income statement until the assets is fully operational. We keep adding it to the value of the asset. After the construction, the asset will start to generate profit, or sorry, the revenue. By generating revenue, then we can stop capitalizing and take the money or the value of the interest to the asset. So we are matching the interest expense with the revenue generated from the assets after its completion. The second point is related to the financial. We know that the conceptual framework of the International Financial Reporting Standard is an attempt to move the accounting profession away from cost accounting towards current value accounting. That is, to provide valuation of the asset as per the financier, which is mainly the net present value. Because the cost accounting is irrelevant, outdated, and will not be of any use to the user of the financial statement. So there is a synthesis between the two professions, accounting and finance. Synthesis means bringing together two concepts and hand in hand, and to provide a logical accounting treatment, which is prescribed by International Accounting Standard number 23 by capitalizing during construction, and after the construction we stop capitalizing. To make this point of synthesis between the two professions, let us have a case. Assume that company A constructed an asset which cost them $100 million, and they incur a cost of $3 million as part of interest payment during the construction period. That means we capitalize the $3 million interest we paid during the construction period, and the value become $103 million. Now let us assume company B construct the same asset, but they finance it from equity, from the owner, the money of the owner. That means there is no interest of $3 million to be capitalized. The cost will be $100 million. So if we finance by debt, the value is $103 million. If we finance by an equity, the value or the carrying amount in the balance sheet will be $100 million. So there will be a logical question here. How come two identical assets appear with different values on the balance sheet, although they are identical, just because of debt financing and equity financing? Why is this difference? Why the valuation in the case of debt is higher and the valuation of the case of equity is lower? Let us continue this discussion. Such a question might lead to a hasty conclusion that the international accounting standards are wrong or flawed. But if we take a look or deeper look at the logic, we might find an interesting story here. How? Debt financing is always cheaper than equity financing because the debt is more secure. The debt holder will get his money if the company goes into bankruptcy. He will get the money first before the shareholders. So he is more secure, less risky. And also the debt holder might have mortgage on the assets, so they can sell the asset in case of default. He couldn't repay. So the debt is less risky. This is why it is less costly. The equity holder, we call them residual claimant. What remains to be claimed by shareholder after we pay the debt holder? So they are inferior to debt holder. This is why they ask for higher equity cost. The higher equity cost will lead to higher weighted average cost of capital, which is used to value the asset, and that means the discount factor will be higher. So it makes sense to see higher valuation of an asset that is financed by cheap debt than the one financed by extensive or expensive equity. Why? Again, let me make this very clear. If I finance my assets through equity, let us say I'll pay 10%. So I will divide the amount by 10%. The cash flow is expected from this asset by 10% in case of equity. But if I finance it by debt, debt will be cheaper, let us say 6%. So the cash flow will be divided by 6%. So dividing by 6% will give value higher than dividing by 10%. And this is why the valuation in our case is $103 million when we finance through debt, and it is only $100 million when we finance through equity. If the accounting treatment being otherwise the same value, then there is a flaw in this treatment. In fact, this treatment is right and correctly priced or valued this asset. I think I made my point. I hope it was clear, and thank you for your time.